So welcome everyone to the second episode of Canon Trading, hosting Ryan from the CME Group on different topics related to trading. And this one is a really exciting one. And both myself and colleagues here at Canon Trading, some of them have been trading longer than I have and know more than I do about spreads. We like spreads. And I say that in a matter of, even though it's not scientific and past performance is not indicative of future results, us as brokers, we see better success rates for traders and clients who utilize spreads either as their main strategy or they're adding it to their strategy. So again, this is just a off note as an observation, and I think you should really listen to the presentation. Pick whatever you need to pick, figure out a few tools or topics that can help you. Explore it in demo mode, in simulation mode. Ask your broker questions. If you're a client of Canon Trading, we'll be more than happy to assist you one-on-one. If you're a prospect, give us a chance and we'll definitely assist you as well. But regardless of what Ryan's going to share, I'm just going to tell you the last thing here is that you can use spreads when it comes to day trading. You don't have to just go short the mini S&P. You can spread it against the mini Russell or a few micros. You can do it for swing trading, for long-term trading. It's a great flexible weapon to have in your arsenal tools. So at this point, I'm going to have Ryan share his screen, and Ryan will just introduce himself briefly. And so thank you, everyone. And Ryan, let me see how I make that happen. Or do you make it on your side?
Yeah, it says the host. I
There
think
you
you need to
go.
make it for me to do it.
Okay, let's see if
Oh,
we
there
can.
we go.
Okay.
Got it. My screen look good?
Yes, I can see your screen.
Perfect. All righty. Again, thank you so much for having me here. Again, session two. So basically, just to recap, session one was more about, what are futures and, how to use futures to identify fundamental and technical analysis, different trends from there. And then the way when we were building out, this series that we were going to do, I wanted it to go in an order that kind of makes sense. So we learned about how to analyze markets using fundamentals, using technicals, and learned a little bit about what futures are and how that works. Now we're going to go into some applications of how to actually look at some of these different markets and how to actually look at some of these different ways you can trade it and establish a bias. So we are going to get into some options as well, very high level. The next session is going to dive deeper into options, how to utilize options, how to look at Greeks, different option strategies. But I am going to touch on what are options to kind of get us going. And then we're going to get into a couple different actual specific types of futures spreads. There's a lot of things that go into this. Being able to, like Elon said to start things off, not only just buy or sell a futures contract that has, a little bit more inherent risk to the upside or downside, you can use futures spreads to kind of collar your costs or to kind of tailor your position to be a little bit more risk managed. Instead of just buying or selling something, you can, look to actually create a spread using correlated markets, using markets that are uncorrelated. So this session will kind of go into spreads, basic options, what options are, and then we're going to go into specific spread examples, which will then lead us next week into more options specific trades, more ways that you can use options in a speculative way. And then the fourth section again is going to just be, hey, let's bring all this together. How do I actually go out and try to do this thing we call trading? So very excited to get session two going here. So I will kind of just jump right into things. So there's a couple things that I really want to portray today. So options on futures and futures spread trading is going to be the general topic we're going to kind of go through. So understanding the fundamental mechanics of options on futures. I spend a lot of time talking to traders, retail traders who tell me, I trade equity options, I trade Tesla options, I trade SPY options, whatever it might be. How do I make that jump to futures? And one of the things that we've really tried to emphasize to a lot of traders is, hey, if you understand options, and you're trading equities, you're about 90% of the way there to look at our futures products, to look at the futures markets and look at options or look at spreads on those products. So we're going to talk about the fundamentals, and we're going to talk about it from the producer side. So, our example is going to be with a farmer, how they can utilize options to create price floors and price ceilings. Exploring how these tools are used for defined risk hedging, and then we're going to define future spreads and the concepts behind relative value trading. So he mentioned right at the beginning, if you want to, instead of just buying the S&P, if you think the S&P is going to outperform, the Russell, you can do a trade that will represent that without just buying one and then selling the other. You can do it as a spread. And then we're going to analyze three key types of future spreads that, back when I was trading these more actively as a broker, a lot of the strategies that we would use with clients, different ways to establish a lot of different types of positions that you could have in any different market. So by the end of this, that's what I'm hoping for. We have a basic understanding of options. We have an understanding of future spreads, and we have a couple real life examples on how to look at these spreads and where you can apply them. And then we're going to wrap it all up with just some common pitfalls of traders and risk management tools. So options on futures. So right away, just kind of what is an option? An option basically on a futures contract gives the buyer the right, but again, not the obligation, to enter into a futures contract at a specific price on or before the expiration date. Basically, these break into call and put options. And again, there's a lot more advanced things that we'll get into next week, or not next week, at our next session. But the basic call option is the right to buy. So when a buyer is bullish, wanting the floor on their purchase price, you can look at a call option. A put option is the right to sell, used when a buyer is bearish, wanting a floor on their sale price. And then the cost is going to be a non-refundable price paid to the buyer or seller, which is known as the premium. So very basic, very basic. Call option, put option is where we kind of just begin this story. I like to compare it to equity options because I think a lot of people understand what equity options are. And I think that it can help draw that bridge between the futures options and equity options and really show that, hey, if you're looking at equity options, we're close. You're getting there. There's just a couple key things that traders and individuals need to understand before entering the different market. So if we look at Apple relative to the E-mini S&P 500. So for Apple, the key differences are going to be the underlying asset, the action upon exercise, and then the leverage. And again, the multiplier as well, which we'll get to. That's part of leverage. But the underlying asset when you're looking at Apple is going to be shares of Apple. So if you're trading an option on Apple, the underlying is just shares. It is shares of that company. The action on exercise is the delivery of stock. So if you have a call option, the end of that is going to be the back end of that option is going to be shares of that equity or shares of that stock. And then the leverage or the multiplier for Apple is 100 shares. For equity trading, any stock you look at is going to be 100 shares. That is the basic layout. So if you look at Apple, Tesla, Nvidia, any of them, if you're trading an option on it, it's 100 shares. And a lot of traders won't even think about it. What they'll do is they'll look at an option on Apple and say, hey, it's an option might be trading at 6.80. But in their head, they see that as $680 because inherently it's that price times 100. Now let's look at futures and what are the key differences. Again, it's going to be the underlying, the action at exercise, and that leverage and the multiplier. So the underlying for the E-mini S&P option is going to be a futures contract. And the action on exercise is the assignment of that long or short of that specific futures contract. And that's super important to know because shares of stock in a futures contract are very, very different. You can lose potentially more than you invest on a futures contract. That is a lot different than just with, shares of a stock. If you buy 100 shares, for $1, you can lose $100. For futures, it's a lot different. There's that inherent leverage, and being assigned a futures contract is a lot different than stocks. Another idea right here is that leverage. So the leverage with futures is higher, and there's a variable multiplier. For example, the micro E-mini NASDAQ. Well, the E-mini S&P, for example. The E-mini S&P 500 has a multiplier of 25. The micro E-mini S&P multiplier is 5 at 1/10 the size. The E-mini NASDAQ has a multiplier of 20. The micro E-mini NASDAQ has a multiplier of 2. So instead of thinking in terms of 100 shares or just times 100 for an equity, you have to look at the leverage is different and the multiplier is different for every single product, every size, and every asset class within futures products. When a futures option is exercised, the holder is assigned a new futures position, long or short, at that strike price. And this new position becomes subject to daily marking to market. So it's key to understand the differences. Those are going to be the big three. But outside of that, understanding optionality, time decay, Greeks, that's all going to be able to apply very similarly to equities if you're jumping from that to futures. So a great example I like to do, and after this we'll get more into spreads, but I wanted to layer in just basic options, preparing us for a little bit more of next week. But it relates to different, options and spreads as well. But thinking about this from a producer standpoint, not speculation. This is farmers, ranchers, you know, oil tankers, people that need to lock in prices for the future. One important thing I always like to highlight is when you think about like a producer or a business that is using options, if there was no ability for a producer to lock in prices at a specific point for a future sale or a future purchase of an asset, it would be very difficult to find people to actually do this job. If someone was going to harvest 100,000 bushels of corn and they were going to need to sell that in 6 months, it's hard to do that knowing the price might drop significantly and there's nothing you can do to manage that risk. Same thing with a company. If an airliner is going to buy, if they're going to buy 10 million gallons of jet fuel in 8 months and they're fully, have no way of protecting the risk against the rise and fall of crude oil prices, how can a company like that expand knowing that their costs might change at the drop of a hat? How can they grow their business? How can they hire? So there's a lot of different things that really being able to use options to create a floor in price or a ceiling in price can be beneficial. But let's get into a farmer's example. And I really like this example because I used to work with a lot of farmers and ranchers, and I spent a lot of time doing this, where we would chat and I would say, how many bushels are you looking to harvest? What's your price that we need to lock in? Blah, blah, blah. We go on and on and on. And we would figure out exactly how to create these price floors. But let's go through a problem. Farmer expects to harvest 5,000 bushels in September, and they're fearing a collapse in price. An action would be buying a September put option of 5,000 bushels at a $6 strike price and having a premium of 20 cents per bushel on that. So outcome number one is the price drops. The market price falls to $5 per bushel. The farmer then can go and they can exercise that put, selling it at $6. And then the net price would be the $6 put value minus the 20-cent cost or premium, which equals a $5.80 bushel per bushel floor in the market. Outcome two, price rises. The market rises to $7 per bushel. The farmer just lets that option expire because the only risk is the cost associated with purchasing the option. So the farmer can let that option expire. They sell their product at market price at $7. So that net price is going to be the $7, which is the market sale, minus just the 20-cent per bushel cost or premium at $6.80 per bushel. So this example, it shows the beauty of an option. It shows how the farmer can guarantee a floor in the market at $5.80 per bushel while keeping their upside wide open. Because like we saw in this outcome number two, if the market just goes up and up, say here we go.
We lost you when you said if the market goes up and up.
Okay, got it. Yeah, I'm back now. Yeah, so basically, if the market goes up to $8, $9, no problem. It's just your net price minus your cost, and the cost stays the same. So the cost is still going to be 20 cents there. So it's a great way to kind of just show from the producer side exactly where we stand and how these are super, super valuable. Now let's get into the spread trading. So spread trading There's so many different ways, and there's literally maybe millions, but there's a ton of different ways that you can use spread trading to establish not only a bias in the market, but a very specific bias in the market. As we look at the environment right now, just thinking broadly about, what's going on, we're seeing the Russell, which is small cap equities, are trading at all-time highs while the S&P and Nasdaq, are a little bit behind it, not at all-time highs, but still performing very well. Now, someone might say, I think that the Russell, that's going to come down a little bit while the Nasdaq and the S&P are going to rise back up to all-time high levels. That is a way you can use spreads in order to establish a position. But let's get into the mechanics first. So, a futures spread involves simultaneously buying one futures contract and then selling the other related futures contract. So, basically, the trade, you're betting on the change in price, in the price relationship or the spread or just the difference, not the absolute direction in the market. What this does is it significantly lowers the risk than you would just trading outright futures. Since you are long and short related contracts, volatility in the overall market is partially offset. So what you'll see is like my example with the Nasdaq and the Russell, let's say. Those two markets are highly correlated. But as you look at it with the Russell at all-time highs and the Nasdaq a little bit lower, they might move up together, but the Russell potentially, if this is what you believe, may just rise a little bit slower or might even come down a little bit, as a lot of markets when they're at an all-time high might just slow down a hair, even if they're very strong, just because the all-time high can be a psychological level for a lot of different traders. What the goal is to capture mispricings or anticipated narrowing or widening of that price difference. So there's, again, we're going to get into three very, very popular examples of how people use this, but there's a ton of different ways you can look at future spreads in order to establish a position. So why trade future spreads? I think this can be super important too, just to understand at a basic level. Again, it reduces risk and volatility exposure because you're buying and selling. Capital efficient through lower margins. Instead of just going out and buying, one E-mini S&P contract, you can go in and buy one and sell the other, so that margin offsets a little bit, and it can be more capital efficient. Your upside might be a little bit capped at what you can make, but your downside risk is also capped. So it works both ways. Exploiting market relationships. A lot of times people will look at like the S&P and Nasdaq are the two most correlated markets that we offer. If you look at those two markets, you can look at the relationship between the two and speculate if you believe that, one's going to do a little bit better than the other or vice versa. You can look at markets that are very, very uncorrelated and you can establish a position there. You can even look at the same market. We're going to get into a crude oil example, looking at the near month versus the deferred month contract. You might believe that in the short term, prices are going to rise, but in the long term, prices are going to remain about the same. That's a way you can establish another futures position. And then commercial hedging as well. We talked about using options, but there are ways to use futures as well where you can establish a position but lower your cost and lower your risk by doing it as a spread. So trading time, so calendar spreads, also known as intra-commodity spreads. So by definition, it's buying and selling the same underlying commodity or financial instrument with with different expirations. So I use crude oil as the example here, but essentially that would be buying December crude oil futures for 2025 and selling March crude oil futures. Basically, it's a trader who expects a current supply to ease by March, but might buy, or sell December, might buy December thinking that in the near term prices are going to be stable and higher. That is a way to establish that position. And there's two different ways to kind of think about this. So thinking about, contango and backwardation. Contango, this is normal market. Contango is your typical market where the far dated contract, so in this example, the March futures contract is going to be more expensive than the near dated contract. So normal market condition reflecting storage costs. Backwardation is when the near term contract is more expensive than the far dated contract. That can indicate a tight supply or a current shortage. This is a very, very common example. A lot of the times when I was working with clients, we would use these kind of spreads to just establish a position longer term. So, we might do this, if it was today and you were looking, for crude oil, you think crude oil is going to go up, over the next couple months, over the next couple weeks. You can put on this position, and that's your longer term position. And then what you can do is you can come in using just straight futures and you can trade around this long-term position using futures, using micro crude oil futures. Within any product, there's a lot of ways you can do it. But this is the most popular spread that we see traders using. One, essentially, it's a quick and simple way to establish a long or short position. And it's a way to do it without the full exposure of just having a futures contract on.
Ryan,
You cap the amount that you can
Ryan,
fully. Yes.
I think you need to share your screen again.
Oh, is it not working?
Yeah.
All righty, let's see it. Does that look good?
Yep. Thank you.
So back to it, like thinking about it, it's a way that traders they can go ahead and they can use this to establish a long or short position and trade around it. So it can be very effective. It's a very common way for a lot of traders to look at these different markets. The next one we're going to talk about is similar, but it can be a little bit different. It's known as the inner commodity spread. So what that is, it's buying one commodity futures contract and selling a futures contract for a related commodity. So, for example, one would be the crush spread. Very, very common looking at the grain markets. So, what this talks about is it's buying soybean futures and selling soybean meal and soybean oil futures against it. So, basically, what you're doing is you're betting on the profitability of crushing soybeans into their component. Another example of that would be the crack spread, very common as well. And that would be buying crude oil futures and selling heating oil and gasoline futures. So you're betting on the profitability of refining crude oil into the end product. So this is where it gets a little bit more specific and it can be based off of, a lot of education and knowledge of the product. So if you're very, very heavily doing research on soybeans or crude oil or a lot of these different products where this can work, you can utilize these spreads to establish a very specific position. Meaning, I believe soybeans are going to outperform soybean meal and soybean oil, which again can be very correlated markets, but due to different supply and demand factors, due to the process, it can be, very different and you could be able to exploit different arbitrage opportunities. And again, it still hits on the fact that this is a way in which you can establish a position in a market while collaring or capping your total cost or how much margin you're going to need to get some of these trades on. They are essential hedges for commercial processors, so for soybean crushers and oil refiners specifically, who need to lock in their profit margin. Speculators can also use them basically to bet on supply and demand imbalances. And with that comes research. A lot of different things go into that, years of experience trading these products and understanding reporting and things like that. But it's a very, very, very good thing to understand at the very least, because knowing this gives you the opportunity to establish a more specific position. The last example is trading geography, known as intermarket spreads. So, intermarket spreads are all about geography and logistics. So, what it is it's buying a futures contract at one exchange location and then selling a futures contract at the same commodity on a different exchange location. Basically, the goal here is arbitrage or speculating on the tightening or widening of freight costs. So a great example is wheat. It's the most common one I've seen, or I'm used to seeing. But buying the CBOT wheat futures and simultaneously selling the Kansas City hard red winter wheat futures contract. A lot of the market drivers here are going to be transportation costs within the different locations, localized supply and demand, depending on exactly what part of the country this wheat is from, quality differences based on if one area, is getting severe drought or one is getting heavy rain or it's a hot and dry summer. That's going to have a big effect on locally a lot of these different places. So the price difference is driven by the cost of shipping the commodity from one location to the other. So you can see that there can be a lot of these differences that can be very, very substantial and can change the specific markets. These spreads are used by large grain handlers to manage risk of their physical inventory across different regions. You'll have these massive grain operations that are all over the country, and this can really affect their end profit. And how they manage that risk is by using a lot of these different types of spreads. And again, it all comes down to logistics and it all comes down to geography as well. So there's a lot that goes into it, but it's very beneficial, again, to really understand. Critical risk management steps. So for looking at options versus spreads, there's a couple different things that you want to understand. So when you're thinking about just options and risk management with options, really there's three kind of basic things to kind of start with when you think about this. And it's the Greeks naked selling and having an enter and exit strategy. I know it just says exit, but enter strategy is important also. So watching the Greeks, I talked about this earlier, and the next presentation is going to be more expansive on options. We're going to get into the Greeks. But understanding how delta and theta impact your daily position. Understanding if Greeks move in a significant way one day over the other, what does that mean for your portfolio? What does that mean for you? Naked selling. There's a lot of traders out there who are very sophisticated that have strategies that may involve naked selling options. For the people I speak to, for people that are new to futures, new to options on futures, it's not something you want to get yourself tied up in. It can be very risky. There's a lot of risks involved in it. So using these spreads or using these options that we talked about today are different ways to establish positions where you can kind of collar your costs and figure out different ways to manage your risk. And then this ties back into our last presentation with fundamentals and technicals, having an exit and enter strategy. Do not wait for an expiration. Have a plan where you know, hey, I've taken my technicals, my fundamentals, and I'm going to find a place to enter the market, and I'm going to find a place that I'm going to exit the market to the downside and to the upside. And then you can trade the premium. So really understanding, hey, this is where I want to get in, this is where I want to get out, this is how I'm going to do it, and then not letting the market dictate where you enter, exit, let yourself dictate that. For spreads, relationship risk. A historically stable spread can suddenly widen or narrow due to unforeseen events. I mean, when we look right now, I talked about the Russell versus the S&P. 3 months ago, if you looked at the two, or 2 months ago, you would have seen the S&P and the Nasdaq at all-time highs, and the Russell, while up, not very close to all-time high prices. And we entered a period where interest rate cuts were coming, and there's still more to come, which typically you'll see small cap stocks can sometimes outperform, your large cap or mid cap equities during that time. So if someone believed that bias, they could have done that kind of spread and understood that relationship. Well, sometimes markets are inverted. Sometimes things happen that just don't make sense. And sometimes that spread can change and not do what you believe it'll do. Even though it happened in the past doesn't mean it's going to happen in the future. So understanding that there is risk, even if they are highly correlated markets. Liquidity is a big one. If you look at more obscure products, some of the more obscure metals products, maybe some of the more obscure agricultural products, if you go to far enough out deferred months, the liquidity is going to be lower. There's not going to be a lot of participants in, way far out like December 2026, December 2027 futures contract. It's just going to get lower and lower the farther you go out. So understanding when you're going to be doing your exit strategy, hey, what does the liquidity look like? Am I going to be able to get out of my position at a price that I'm comfortable with? And that's going to be super important as you're looking at, entering in your exit strategy. And then your overall leg risk. So the two contracts that you have, the buy, the sell, and the sell and the buy, the legs may trade at different speeds, which can lead to slippage upon entry and exit. So, like I said, if you're in one contract and in the near term prices just shoot up, but in the long term prices are just up slightly, and it's a way far deferred contract out to December of 2027, that contract is going to trade a lot differently on that leg than the front month one that's way more active. So it's key to really understand your leg risk on each side of the trade and, understanding where you're going to be able to get out of some of these contracts. Now, thinking about managing futures trades. There's a lot of different things that you need to think about, and we've talked about this in the last session, but I think it's super important, especially when you think about options and when you think about spreads. So the key one, know your expiration dates. That's going to be almost the most important, not only the month, but you need to know the date. Because as you start approaching expiration, what you don't want to happen is you let the expiration date dictate when you get out of a trade. You need to know when the expiration is so you can plan it. But what you don't want is it to be 3 days from expiration and then you're just stuck holding it and you hope for the best and then you take it off at the last second. It's going to not work out. Understanding settlement methods, cash versus physical. Again, we talked about this too, but it's going to be very important on how these products are actually going to settle. Planning your roll strategy, monitoring your spreads, being aware of that contango and backwardation that we spoke about. Practicing risk management, utilizing roll orders, being able to one-click roll functionality, your contract from 1 month that's going to expire into another month that's going to be more active and be the new front month contract. And then staying informed and reviewing broker fees. Again, that's more of a personal thing for individuals, but understanding, hey, what exactly am I doing? What is going on in the world that can dictate how I'm going to trade this product? And what are my overall fees? What are my margins? What are the specs on this trade? Are all going to be things that go into managing your futures trades at a high level. So to kind of conclude and to kind of wrap things up. So options on futures, what do they do? Options on futures offer the ability to take a leveraged position with defined downside risk, making them very effective for establishing price floors or ceilings. Futures spread trading provides a capital efficient method for profiting from the temporary mispricings or changing economics between related futures contracts. So again, that's, hey, I think that the S&P is going to outperform the Nasdaq for the rest of the year. So you can buy the S&P and sell the Nasdaq. What that's going to do is instead of just buying the S&P, that's going to reduce the margin. It's going to reduce your overall risk for that trade, and it's going to let you be able to sleep at night knowing, hey, worst case scenario, I'm going to be okay on this trade. And then the key to success, in-depth knowledge of both the underlying futures market and the math behind the mechanisms of the derivative instrument. So again, this ties back into our last presentation about fundamentals and technical analysis. So really understanding what is this underlying that I believe. I've used the Russell example a few times, but understanding, hey, if I think the Russell is going to go up, that is small cap equities. When do small cap equities typically perform well? And then from there, it's taking that. If you believe that they're going to perform well, then you can take that information and you can establish a position using your technicals, your entry and exit points, find where you want to enter the market, and then you look at, okay, now how? And that can be used with an option. That can be used with a futures spread. And there's a ton of different ways that you can dive into it. But these future spreads, they offer just so much, and there's so many more we didn't get into. As if you take some time and look it up on your own, you'll see there are countless numbers of spreads that you can actually trade, that you can be active in, that you can try to make money in and speculate. They're there in order to not only protect you, but they're there to have you actually speculate and make a play or position in the market. And it can be very beneficial, not having to worry about your futures, product overnight, getting sent sideways because of a tweet, or because of a major news bound that went off. This really gives you the ability to lower your overall cost for the trade, lower your margin, and have you be able to look at other markets if you want as well. So again, as we kind of wrap this up, the next session we do is going to be more heavy in options. So what we're going to get into is not just what is an option, not just calls and puts, but we're going to get into, hey, what are the Greeks? How does option work? How does time decay work? We're going to get into all of that different stuff. And I'm really excited for
Option
that.
spreads. Are we going to touch base on
Yes.
option spreads? Excellent.
Yep, option spread
Excellent.
specifically. And then what we're gonna do at the fourth session is gonna be, hey, let's bring all this madness together. And how do we go and we try to apply this to trading? So again, super, super happy to be able to kind of continue this session. I think it builds well off the last one, and I think the progression really makes sense. And I'm looking forward to our next session, and happy to answer any questions we might have.
I agree. And while we're waiting for questions, first of all, I'm going to thank you. Very nice. Excellent information. Good refresher for traders who've been in the business for 30 years plus and for newcomers. So thanks, Ryan, and thanks CME Group for the research, the time.
Of course.
Again, everyone, I believe this is excellent information, top notch, but keep in mind that this is educational purposes only, and futures trading is risky. And do your due diligence and exploring, trying, simulating, asking your broker if you feel that they have the right experience. And if you feel they don't have the
Yes.
right experience, come to Canon Trading. You'll find some very experienced brokers, and we'll be more than happy to assist you. Questions and answer. Um, so one question that I have is for the next webinar, actually, will you be talking about reading the Greeks?
Yeah, so we're going to go through all the, what is theta, what is delta, what is gamma. I'm going to go through all of it. I think it's super important to know not only, what they are, but how they relate to each other. So that's going to be kind of a big part of it. And again, if you know them from equities trading, it's going to be a refresher for you, and you're going to see it's very similar to what it looks like for futures trading. So
Okay,
we're going to hit on that for sure. We're going to get into it. We're going to get into optionality. And then I'm going to try and get some real examples of different futures contracts and different options that you could look at there.
perfect. And another question, and I'm going to share my screen while we do that. Another
Yeah.
question is, can you see my screen? Yes. Another
Yes.
question is the margins on spreads. Obviously, most spreads will have lower margin. Some of them quite a bit lower, meaning a bean calendar spread, the margin is going to be extremely low. While if you do a silver gold spread, it may not be as low. So any pointers that you can touch on that, Ryan?
Yeah. I mean, if you're looking at like corn, for example, like one thing to think, like if you're looking at like December versus March corn, December, if you're buying December and selling March corn, those markets are what you're basically saying is those prices are going to move pretty closely to each other. It will be rare that you'll have, corn, December corn up 1% and March corn down 1%. What's going to happen is a lot of the times they're going to move in similar fashion, but the front month and the back month, it'll be the velocity of the move that's different. So the front month contract that you're buying might move more than the deferred month, and that's kind of what you're trading is saying, I think near term prices are going to go up relative to short term prices.
Right. And another question that is a good question. Any books that you can suggest reading about getting into spread trading that you maybe have read in the past or that you like? Think Ryan having some connectivity issues. So we will wait for that. Are you back, Ryan?
Yes, I'm back. It said I disconnected.
That's okay. I saw books on spread trading.
Eh, Yeah. Yeah, no, but basically, the second point to that was like if you're looking at like gold and silver, for example, like gold and silver, they fundamentally don't always, they're not 100% correlated. Gold is essentially a currency, and silver is, an industrial metal. So sometimes you'll see silver is up 1.5% and gold is down on the day. You won't typically see that big of a price gap between like the same commodity in the different months, but you'll see that with completely different commodities. So that's why the margin, could be a lot lower
So
for just
what I'm
corn and
doing while
corn.
you answering, I'm using our margin calculator. And again, if you have any questions about specific margins for specific spreads, call us. Eight, I'll put the 800 number here somewhere. I think it's on our website.
Yeah,
Yeah. And we'll calculate it for you. For example, the gold, the silver we just discussed. I'm curious myself.
yeah,
So let's take a look and see what happens if you go long silver and short gold. Okay, so that's not bad. That's actually 11,000 for the spread,
yeah,
while gold by itself is 20
yeah,
and silver by itself is 20. So instead of being 40, it's actually 11,000. So that's an example. And again,
yep.
as Ryan mentioned, when it's a highly correlated market, more like calendar spreads, let's see what happens when the other one is the February gold for in this example. Oh my God. I mean, this is like less than $600 margin, obviously, because you long a December gold, you short vice versa. You short a December, you long a February gold. This correlation between those markets is extremely high, and that just
Yep.
to validate the point that you mentioned.
Oh yeah, yeah. It's and you know that it's very dramatic, and it's dramatic for a reason. It's your upside is limited on a trade like that, but your downside is limited too. And it's a good way to establish a position without just shooting from the hip for a straight futures contract.
Thank you. And there's a few questions actually today, more than usual. Are you guys a prop firm, private equity, hedge fund? The answer is none of the above. We are a commodity future brokerage house, been around since 1988, and we assist clients trade either on their own with trading platforms that we can support, accommodate, and educate, or through a broker if you'd like, as well as automated trading, some managed accounts, but we're a futures trading brokerage. That's what we do. Another question in turn, how do the option spread trading compare to futures real-time intraday trading in terms of time to entry to exit close of daily trades? So I think I understand the question and I'll take the liberty to answer it. If you're putting a
Hmm.
market order run on a gold futures or gold options, the fill will be instant on both of them. It's in milliseconds. Now,
Hmm.
if you're putting a limit order on a gold contract that's trading quite a bit of volume on both sides, or you're putting a limit order on a gold option, call option that is $100 away from the money for the month of April, there's going to be much less liquidity in the option out there than on the front month's future. And the liquidity and limit orders will make the difference. One more, one more. Are all these intra and inter-commodity spreads you are talking about recognized by the exchange? Can these spreads be charted like an outright futures contract? I'll answer the charting part. The charting part, it depends on your platform.
Yeah.
And we have most of our platforms will chart those spreads, and we can show you how. Ryan, if you don't mind answering the recognized spreads by
Yeah.
the exchanges question.
Yeah, I mean they are again like this. It will your brokerage matters. So I worked with a couple different brokerage firms, and you can honestly, when you're building a spread, some of them will let you just specifically say, "I want to build a calendar spread. I want to build a intercommodity spread, whatever it is." But they are recognized by the exchange as long as your broker offers that kind of trading, you'll be good to go.
Excellent. Excellent. And back to the question about books. I think we missed that one. Any books that you recommend? I can share while you think about it, Ryan. I can actually share some resources that we have right here under the education. If you go under educational, you can read an article we wrote about seasonal spread trading. Okay.
Mhm.
Another source that we really like as Canon Trading as brokers is a website called mrci.com. Uh,
Yep.
we really like this resource. They have a lot of information, a lot of back testing that they do, different correlations, different resources. So
Great seasonality.
yeah, great seasonality and some good, really good information like free futures research, some articles, and uh, and Mike, I'm sorry, Miles, who's asking the question. We will internally see if there's any books that we can think of that we can recommend. But I gotta be honest with you, the biggest source for me as a broker when I started to learn about spreads were the colleagues I'm working with who had experience in spread trading.
Hmm.
Probably much more valuable than any book, just FYI. And we do have brokers here that are very knowledgeable about spreads.
Absolutely. Yeah, I couldn't agree more. Just education about it. I will say the best trading book I've read is Trading in the Zone, Mark Douglas. Very, very good. If you're new to futures, if you're new to trading, it's very interesting. It's a fun read. Education wise, it's a lot different. It's not going to be your straightforward education you'll get with a Canon or with the CME, but it's good. And I like to recommend it if people are interested.
And I'm gonna think about some books and see if we can come up with a book that we can share with you. And in between, again, feel free. There's something we do have a course here that is offered by the CME, Understanding Future Spreads. I
Hmm.
would recommend that. So
Yeah.
on a website, education, trading courses. Scroll down and you get a free, looks like an hour course that is an accredited course that you can take, and that'll be a great start. And I know we're
Absolutely.
running into the end of the allowed time. So let me see if there's any other questions that I missed. Okay. All right. Any other specific questions anybody has that we did not answer, feel free to email us at info@Canon Trading Company, or just come here and click on the contact us and send us a message, or even simpler, pick up the phone. We will answer the phone. So
Fantastic.
Ryan, thank you very much. We look forward for the next webinar, and thank you everybody for taking time of your day and attending this webinar. And we look forward to seeing you on the next one.
Yeah, very excited. We'll dig into the options on the next one. We'll get into the Greeks, and it'll lead us into our final session. So looking forward to it. Thanks for having me.
Of course. Bye everyone.